Hi everyone and welcome. Self-employed friends, listen up. This video is specifically for you. A lot of people don't know that buying and owning a home comes with certain perks for self-employed people or those who have their own corporations. And so I have brought my good friend Dan Schwartz, CPA and tax attorney, to talk about all the different considerations that you should be thinking about when it comes to buying a home, preparing for that, the actual time of home ownership, and certain considerations for your exit. Dan, thank you so much for being here. I'm really excited to have you because I think you're the perfect person to shed light on certain perks that having your own corporation and being a self-employed person has over being a W-2 employee. So first I'd like to start off with you telling us just a little bit about you, and the reason I have you here because you're a glutton for punishment, as I like to say, a dual licensed CPA and attorney. Tell us a little bit about your practice and what your specialty is.
Sure. So unlike some of the attorneys turned accountants or accountants turned attorneys that you find, I actually do both. And so I definitely am a glutton for punishment, I think. I also took a couple extra bar exams, so I'm also certified as a taxation specialist and an estate planning specialist.
Just a couple extra bars.
So I take all of this, this extra education and I put it together into a single practice where I help people with their taxes, their income taxes, and also help them with their estate planning and all their business transactions and everything in between. So it's like two sides of the same tax coin. And instead of having to go to two different professionals, I can help them with everything in-house.
You're the one-stop shop.
That's what I try to be.
Exactly, yeah. And you've definitely helped several of my clients. I've referred a lot of people over to you, and you've been a great asset to them. So, so again, thank you. So let's start with, let's kind of break it down into pre-buying a home, and then talk about during home ownership, and then we can talk about the exit. Okay,
Sure.
so let's break it down that way. So for a self-employed person, what do they need to take into consideration when it comes to planning to make their home purchase?
Sure, and so this applies for anyone looking to buy a home purchase. First thing they should do is they should talk to you and budget to see what kind of home they can afford.
Right.
I have not had the best luck with real estate. One of the things that I was unlucky with was insurance costs on a home that I was looking at. And it just completely blew me away how expensive the insurance was. It was
Right.
3 or 4 times what the insurance cost was on the house I eventually purchased. And so when you're looking for houses, definitely reach out to your insurance advisor, price out the insurance. Next, you probably should know what's deductible and what's not deductible as a homeowner in general. You can deduct your property taxes and your mortgage interest expense. So your property taxes, it's not a secret what they're going to cost. It's always 1.25% of the purchase price, plus or minus depending on where you live.
For here in LA County.
In LA County. And so that's going to then be your base value, and every year it's going to go up 2%. And sometimes it's going to go up a little bit more depending on what your county does or your city. And sometimes they add bond measures and it costs more. So that's going to go up every year. And so it's not always fair that the person next to you is going to have a property tax bill that's a fraction of yours as a new home buyer. And then lastly, there's your mortgage interest. When you get your 1098 at the in January, rather, for the prior year, your Form 1098 is going to tell you how much you paid in mortgage interest. And so you can't deduct the whole thing if you bought a really expensive house. So right now the limit is the first $750,000 of your mortgage. The interest on that you can deduct. And there's different limits for California because they don't conform to what the IRS does. And then to make things even more confusing, in 2 years, the law is automatically changing. It's going to go from $750,000 of that mortgage to $1 million.
Okay.
And then on top of that, you get another $100,000 of other debt that you can deduct the interest on. It doesn't necessarily have to be for your house. It could be for a boat, for an RV. It doesn't matter as long as it's secured by the house. So really up to $1.1 million in a couple years, you'll be able to deduct the interest on.
I feel like that's a good change.
It is if you're not in LA.
Okay, well, I feel like that could be like a whole other conversation about LA versus other areas. So just to kind of give a little recap, obviously homeownership does have its benefits, and we're going to go into that in a little bit specifically for self-employed people. But step number one is when it comes to budgeting. Obviously, I actually love the point that you brought up about shopping for insurance up front. Also, just recently I had my insurance broker and we were talking about how insurance companies have just up and left California, and that's been leaving a lot of people in a tight spot with much fewer options and increased insurance costs. So to my clients, one of the things that we always talk about before we actually start the house hunt is, okay, what can you afford, and part of that is, okay, let's get your pre-approval going. Let's take a look at your income, your expenses, talk to your CPA because they know the ins and outs of your financial picture. And especially if we don't do it up front, like before we actually write an offer on a house, at least at the latest in the escrow phase, we're looking at insurance costs because we want to make sure we're doing that before we remove all of the buyer's contingencies, because that could be a really big surprise. Sometimes that could throw off your whole budget in terms of affordability.
There are a lot of things that will surprise you after you close, most likely the repairs.
Right.
And everything that's breaking all the time, but it's still worth it to own. But
don't scare people.
You don't want to be surprised by your mortgage, your property tax, your insurance.
Right.
Those are the big expenses.
Well, and you also don't have to be surprised by that stuff because it's all numbers. It could be planned for, it could be shopped around for, or they're set by the county. One of the things that we, one of the reports that we get during the escrow period is the NHD report, or the Natural Hazard Disclosure Report, which also includes a section on taxes. The property taxes, if there are any other like Mello-Roos taxes and, those kinds of things that a buyer has to take into consideration. So in addition to, the budgeting and the affordability, how much are you going to put down? What's your monthly mortgage going to be? Talking to your CPA would be a great resource for you to understand what your certain taxation liabilities are going to be in terms of your overall budget. So I think that's really important to have like a good understanding of when you're buying a home.
And your CPA can definitely game this out for you, and you can tell him or her how much of a mortgage you're going to have, what the interest rate's going to be, how much of a house, how expensive a house you're going to buy, and they can tell you exactly what your tax bill will be under all these scenarios. Relatively
awesome.
Easily, relatively inexpensively, so don't be afraid to reach out.
I love that. I think that's really great advice. I think one of the things that I share with my clients, especially when we're sitting down for the first time to plan out their home buying process and whether or not home ownership is feasible for them or right for them at this point in time, I tell them that, it's my job to help build a team around them. I'm not a CPA, I'm not an attorney. I can't advise on taxation issues or legal issues. I have certain working knowledge, but I'm not the one who holds the licenses and the degrees for that. I can advise on the real estate transaction, which I do, but having these other people that are such important elements of the homeowners or the home buyers experience is so essential. So I love that you said, do reach out to your CPA and really just map it out. I think you'll have a lot more peace of mind going into your purchase, going into the experience of home ownership when you have taken all the numbers into consideration and you can plan for it. So thank you for touching on that. Let's talk real quick about being self-employed versus being an employee. From a pre-approval perspective, which you're not a mortgage lender, but one of the things that we come across in the pre-approval stages, it's pretty easy for a W-2 like wage earning or salaried employee to get a loan because they have their W-2s, they just provide their their tax papers, their bank statements, everything's very predictable, they're getting paid every 2 weeks, and getting pre-approved, assuming you have the right income and debt ratios for the purchase price that you're looking for, it's kind of slam dunk.
Yeah.
Okay? For the self-employed, it's a little trickier because they're
Out the window.
You're right. It all goes out the window because as self-employed people, we have certain expenses we can deduct, and everybody's really excited about, well, I can write this off, I can write that off, so I can legally minimize my tax consequences, which means that you're going to have to minimize your income, which could then on paper show that even though you're a successful business owner and you're making money, you can't qualify for a home loan because you've deducted too much, which I think is another reason why if you're looking to buy a home and you are self-employed, you should definitely be talking to your CPA at least a couple years in advance. I feel like, hey, I'm planning on making a home purchase. Or what do you, CPA, think about me buying a home? What should my income look like? Can you touch on that for a little bit?
Sure. I think that lenders do know that if you're self-employed, that your income is variable, and that's part of why they're so concerned, but that also that there are different levels of how aggressive people are in deducting expenses.
Right.
And so what I see as the bigger issue, or the biggest issue when you're looking for a home as a self-employed person, yes, you want to make sure that you qualify based on your income level, but just know that you're going to have a totally different experience as a self-employed person versus an employed person, because the bank is going to be looking at your CPA to provide some level of assurance, and your CPA is not going to do that. Our insurance will not allow us to say, yes, they're self-employed, yes, they're going to make this much money in the future. And so don't be afraid when your accountant has that conversation with you and says, I cannot certify these things. The banks know this. They're trying to get someone else on the hook for you as the borrower. They'll get over it, and they usually get over it. I have not seen a single escrow fail because the CPA says, no, I'm not going to do that. But it's always helpful in advance, let your CPA know that you're going to get this call. I can't tell you how many times I've gotten a call from a bank saying, hey, can you certify X, Y, and Z? And I said, I don't even know what you're talking about. I'm not certifying anything. And having that conversation in advance, I think, will make things go a lot smoother.
Yeah, I agree. I think that's really important. Again, it comes down to building that team of experts around you who is going to, who will help you along your path and advise you accordingly.
But one more thing to keep in mind is that you have to have books for the current year ready and ready to deliver to the bank, because they're going to want to know that your income is the same as last year. It helps if it's better, but if it's it doesn't have to be usually a complete set of books. It doesn't have to be prepared by a bookkeeper. Usually they just want an Excel spreadsheet. Just know that you're going to have to provide that.
Yeah, I mean, they'll definitely ask for the tax returns, bank statements, P&Ls, all that kind of stuff, depending on the type of loan that you're getting. So, which is why I think having a pro do all that stuff for you as opposed to you doing it yourself is the way to go.
I agree.
Yeah, that's my personal opinion. That's what I practice. Let's talk a little bit about when it comes to being self-employed. I know you and I have talked about being a sole proprietor versus having a corporation. Now, technically, those are, I don't want to say technically or not technically, that's some forms of being self-employed, but I know when you have a corporation of your own, you as the individual will end up being an employee of the corporation, right? So let's talk about homeownership and the differences between being a sole proprietor versus having a corporation. Do either of those have any sort of effect on the perks of homeownership, or are the perks the same and they're just kind of nuanced and categorized a little bit differently for being self-employed?
They're very similar. They're not always the same. Contrast both of those against being a W-2 employee. Currently, you can't deduct your home office if you're an employee and you're working from home. It used to be deductible as it's called a 2% miscellaneous itemized deduction. That went away. California still allows it. In 2 years, we'll have this back. So this means that if your home office expenses exceed 2% of your income, roughly, you can deduct anything above that. End result is most people aren't going to be able to deduct their expenses as an employee, unless they have lots and lots of expenses as an employee, which raises some other questions as to whether you're really an employee or whether you should be paying those expenses. Most people can't deduct their home office or their car or anything as an employee. When you're self-employed, that means you have a sole proprietorship. You file a Schedule C to report your income. That's attached to your tax return. That's why a lot of people don't like being a sole proprietorship, because then that's the most highly audited form that an individual might have.
Okay.
And so that's why I tell all my clients that an S corporation provides tangible and intangible benefits. Tangible being that you don't have to worry as much as of the risk of an audit as my self-employed sole proprietorship clients.
Oh, that's great. That's really good to know. So if you do have your own business and you are working for yourself, your professional opinion as a CPA is don't just stick with sole proprietorship, create an S corp.
Well, every situation's different.
Okay, right.
But once you've hit a certain threshold of income where the costs of maintaining this structure are not going to be too burdensome, definitely an S corporation is the way to go for both tax benefits and for those intangible benefits of not worrying as much.
Oh, I love that.
You're not allowed to deduct anything extra. It's not like the rules are any different. And I'm not advocating that you deduct frivolous things, but the fear is minimized.
Got it. Okay. That's really good to know.
So as a sole proprietorship, as a Schedule C filer, you can deduct your home office. And so there's two different ways that anyone can deduct their home office. There's the $5 per square foot method, maxes out at $1,500, not a very big deduction. Or you can take your pro rata share of all of your house expenses. And so that's usually going to give you a lot more bang for your buck, but you have to track your expenses. You can't just, well, you can, but you shouldn't make up numbers.
Right.
When I see round numbers at the end, my utilities were $2,000, I know that's a made up number.
Right.
So you definitely want to be able to substantiate these numbers if you were ever audited.
Okay, that's definitely good to know.
The difference between being a sole proprietor and having an S corporation is that you can generally you can depreciate your home office. And so the way you would do that, first you have to track your purchase price, you have to track all the improvements to your home, and then once you've figured out what your percentage of the home office is as it relates to the entire home, you can depreciate that portion. And so depreciation is where you take a deduction for a fraction of the home's purchase price and plus all those improvements each year over decades. And so every little bit counts. And so it helps you increase your deductions when you're a sole proprietor by not only taking your actual home expenses, but depreciating the home itself. This is all a timing issue. Eventually, you're going to recapture that when you sell. But for now, you'd rather have a deduction now and deal with a lower tax rate on that recapture later.
So this is just for the sole proprietor, not for somebody who has an S corp?
So when you're an S corp, when you have an S corporation, you're generally an employee of your own S corporation.
Right.
And so the way you deduct a home office is through an accountable plan. That's essentially where you submit proof of all your expenses. You're submitting it to yourself because it's your own corporation, but you submit proof of your expenses, which would be your pro rata share of all your expenses for the home office as it bears to the whole house, and then you get a deduction for that.
So I would like, for example, write myself a check every month for office rent, for example, or on whatever schedule, and submit that as an expense. No, not write myself, but write the corporation, rather.
The corporation would reimburse you for that and take a deduction for that. If this is your own corporation, you don't need to do it monthly. You don't even need to write a check. You just calculate this, and your accountant will factor it into the income and treat it as a form of a distribution.
Okay.
So there's no money that needs to change hands. It can just be an accounting entry.
I see. Okay.
So, but the difference is that you generally don't depreciate your home with an accountable plan. I know some commentators say you can. I think the more reasonable position is that you don't. And so, yes, you can get more bang for your buck with the sole proprietorship. You can get depreciation. You can juice your deduction each year. But as more and more people move towards S corporations, the accountable plan, I think the better thing to do is not to do that. And that also makes it easier when you sell. You don't have to worry about depreciation you took in the past.
I see. Yeah, and because there's always taxation matters to address when you're selling a home as well. So I actually think this is kind of a good segue, but just to kind of recap this portion of the benefits of owning a home as a self-employed person, whereas you are a W-2 employee, you can't deduct certain expenses for a home office or other business expenses that relate to the home. And you also can't have any depreciation benefits either as an employee. As a self-employed person, as a sole proprietor, you can.
Correct. You could actually depreciate your home as an employee, but you're never going to get above 2%.
Above 2%
of your income,
on that.
so it's just wasted.
Oh, I see. Okay. All right. That's a good distinction to make. Okay.
If you, as an employee, if you have to start talking about your expenses, they have to be significant before they're ever deductible.
I see.
In many cases.
Okay.
And it's not a good position to be in when you're an employee.
All right. So moving into the topic of the sale, or let's just talk about the exit, generally speaking, because you don't necessarily have to sell your home to exit your home. Maybe you've outgrown it, you want to move someplace else, you have an option, depending on what your bigger financial picture looks like, you can keep the home as a rental property, potentially.
That's a great idea.
You can also sell it and take those funds and put it into your next property if that is what you prefer to do, or maybe just need to do. Sometimes people can't afford to hang on to the existing property and buy another one.
Right. So
what does somebody in each of those positions need to take into consideration on the exit? We're talking like capital gains or any other sort of
Sure.
tax matters.
So it should be said that when you go to qualify for a new loan and you're hanging on to the old house, the lender is going to examine to see, can you afford both houses?
Mm-hmm.
And that's another hurdle that you might not be able to cross or go over, even though you might be able to, even though you think you might be able to afford it, the lender might disagree. And so hanging on to the house, I think, is an excellent idea because you can rent it out, produce a source of cash flow to pay for the new house, and we mentioned depreciation before, you'll be depreciating your old house based on the purchase price and all the improvements you made to it, and deduct 1/27th of the property, not the land, but whatever we allocate to the building.
The structure.
Right.
Yeah.
We'll allocate a value of the entire thing to the structure and deduct 1/27th each year. And that will shelter a lot of your rental income from taxation. Real estate is the last great tax shelter there is. This is how you create wealth, is you rent out your old house, don't pay tax on it, and then there's other strategies in the future for that. You can even use the equity in your old house to pay for the new house. Mm-hmm. If you can take out a loan or a line of credit based on the equity in your old house, you can then apply that towards buying the new house or buying another rental property down the road.
Right. Yeah, that is something that I've advised clients who do have a lot of equity in their home or in one of their properties, and they want to grow their portfolios, they want to build their wealth, to tap into the equity in their home to buy another asset.
Right.
Not to tap into their home's equity and use it as an ATM machine.
You don't need an RV.
You don't. You don't.
But this is something, and I'm glad you tell your clients this is something that a lot of people just overlook or forget. I just all the time I get calls on this exact subject. Mm-hmm. What do we do with the old house? And I ask them, have you considered renting it out and taking a line of credit to pay for the next one? And it's smart people, but they've never even considered it.
Yeah.
Because just the thought of having, they're not landlords, so why would they have a rental? It never even occurred to them.
Right.
And if you don't want to be a landlord, you can always get a management company. They'll take care of everything, and you just hopefully the value grows.
Yeah, and at that point in time, you'll pay the management company whatever percentage that they charge of the gross income. You just have to be in touch with the management company, manage the management. That's right. Pretty much all you have to do. But you do gain those benefits of passive income. The property, if you hold on to it long enough, will likely appreciate. You're taking the depreciation perks as well. It's just, I love what you just said a minute ago, which is this is how you build wealth.
Right.
And a lot of people you're right. They don't think of themselves as, investors necessarily, but when you do have a property, maybe it's not, an income producing asset when you're living in there, it's not producing income for you, but you do have certain other tax and financial benefits that that will certainly help you. And then again, this is why having that team of professionals around you is really important, because you've been advising your clients really well. You're actually getting them to think about, how do I build wealth? How do I use the asset that I have to help me jump to that next level? And so I think that that's really great.
And you mentioned sales before. If you don't want to be a landlord or
Which
even
some people
manage
don't,
the manager, the good news is that it's, if assuming you've been in the home for longer than a year, there's a really good tax benefit available to you. If you've lived in the home for if you've lived and used, or rather owned and used it as your primary residence for 2 out of the last 5 years, you can exclude $250,000 of the gain. So the gain is the proceeds that you get from the sale minus your expenses, minus your original purchase price and all the improvements you made to it. That's your gain, and then we lop $250,000 off of that.
It's like you don't have to pay taxes on that first $250,000 worth of gain.
Exactly. I can't tell you how many people in this country, I haven't talked to them all, but they think that there's no gain on the sale of your primary residence. I don't know where they came up with this idea, but it's pervasive. This is what we have in this country. You have $250,000 off the gain. If you're married and your spouse has also used it for 2 out of the last 5 years, you can exclude $500,000.
So the 250 is for a single individual person, and it goes up to 500 if there's a married couple or a partner, 2 people.
So you're actually incentivized to buy and sell your primary home more frequently than you might like. If there's an appreciating market, the best thing you can do is sell it and pay no tax and buy your next home. And that's why we need you, because homes keep going up in value in LA, and you can easily, over a 10-year period, exceed $500,000 of gain.
Yeah,
and
absolutely.
The only other way to avoid the gain is to die with the home when you get a full tax basis step up. But that's for another conversation.
Well, actually, you know what? I know when we were planning for this, we did talk about that. But the fact that you brought it up, I think is certainly worth addressing. So I'm actually just going to turn this over to you. Let's talk about what is that step up in basis? What is that tax benefit that family members or like an estate can experience upon the death of a homeowner? What are those considerations?
So we were talking before about calculating your purchase price plus all the improvements. We don't need any of that. Your new tax basis, which is what we base our gain or loss calculation on, is the fair market value at the time of death. So if someone dies, the person that's in charge might need to sell the home, and they'll call up the accountant and say, what do I owe on the sale? They bought it for $100,000 40 years ago. Well, you don't owe anything because we have a full tax basis step up to fair market value. Not only that, we might actually have a loss if you sell it soon, because of all the expenses from the sale of all the escrow costs will actually result in a net loss at the end of the day.
So I'm so sorry to interrupt you. Finish your thought, and then I'm going to share a little bit of context.
So the beneficiaries, they don't owe any tax when any asset, almost any asset, is sold when someone dies. And so there might be an inheritance tax, an estate tax on the very, very wealthy, but there's no tax otherwise for the person inheriting the property.
So I'm really glad we're talking about this. So I want to put this into like a real life scenario. Okay, I do speak with a lot of people. Actually, I'll use a real example. Good friends of mine, their mother owns a 4-unit property. Okay, it has been in the family for over 40 years. The mom is now in a home. Now, I know this is like an investment property right now, but the family has been thinking of, we're tired of managing this. It's far, it's not in the neighborhood where it's easy for us to stop by and make repairs anymore. This property has become a little bit of a burden. We're thinking of just selling this property. And so I did an evaluation for them, and I saw that back 40 years ago, the family bought it for less than $100,000. And now the fair market value is actually around $1.1 million. And what I explained to them, again, I said, I'm not a CPA, but you're definitely going to be having a massive tax consequence if you sell this property at $1.1 million today, and the gain is $1 million. I'm just using rough numbers. Obviously, there's a depreciation, the expenses, all that kind of stuff. But if you have $1 million gain, you're going to be paying a boatload of taxes. Whereas if mom at this stage, she's already in her 90s, her health is ailing. If you hold on to it long enough, wait until she passes away, you'll get what's called like that step up in basis. So when you hear the term step up in basis, that's what that means. The cost is adjusted to the fair market value, and then you sell it.
Do whatever you can to hold this
Do
property.
whatever you can to hold on to the property. So when I had this conversation with them, they were like, oh, and then I said, and talk to your CPA about this, because I can only give you the broad strokes. They said, but now knowing the words you need to use to talk to your CPA, and I'm like, report back to me what the CPA say. They called me up like 2 days later. They're like, Christina, thank you so much. We're going to hold on to this property. I said, I'm always here for you whenever you're ready to sell it. But as your friend, as your realtor, as your fiduciary, I'm telling you, just hold on to it. And I'm glad your CPA told you the same thing. So what Dan just explained about that step up in basis and paying no taxes, no capital gains tax on that. Again, forget the inheritance tax, is a different story. But not having a capital gain that you have to be responsible for paying, especially when there is such a huge gap between the fair market value and the original cost basis. I mean, that could have saved them tens of thousands, hundreds of thousands of dollars in taxes. What?
If they had $1 million of capital gains, we would take maybe $250,000 off if it's just mom, and they would have gain of $750,000. Right now, we have a top capital gains tax rate of 23.8% once you factor in all the non-capital gain taxes on there. So that's some serious money that you save them.
I did a really good job.
You're going to be sitting for the CPA exam next.
No, definitely not. I'm going to leave that up to you. I will. That is one exam I will not take. I have you for that. You're good.
Happy to do it.
Thank you so much for bringing that up. I think that was really important because it's a very common scenario. Some people just don't know what to do with real estate that they're not really involved with or utilizing. It's very common. And it's not just common for investment properties like that 4-unit property I just talked about. It could be the same thing for a primary residence.
Do whatever you can. Take out a line of credit. Take out a reverse mortgage. Know that you have to pay it back really quickly. Get a renter in there. Do whatever you can to keep the property for however long is necessary within reason.
Right.
But when you're dealing with mom and dad and they have to go to assisted living or they have to move out for health reasons, do what you can to avoid those taxes because it can be egregious.
Right. I mean, especially what you explained, like with that capital gains. You said that the top tier now is 23?
23.8 after you factor in the Obamacare tax of 3.8% on top of the 20% max capital gain tax rate.
That's a big chunk.
Yes.
Yeah, that's a big chunk. Wow. Okay. I'm so glad we talked about this. I think it's so valuable. So we've talked about the pre-home buying, budgeting, getting to know what your expenses will be so that you're not just budgeting for the actual purchase, but for the maintenance and the ownership of the home thereafter. We've also talked about during home ownership, certain perks that being self-employed will garner for you in terms of not just depreciation, which is applicable to both employees and self-employed people, but specifically for the self-employed, taking certain deductions, okay, like for your home office and those kinds of things.
All your insurance, your cleaning, your...
Okay, yeah, rattle it off.
Yeah.
Let's go.
Let's say you see people at your home office.
Like if a client comes to your home office.
Client comes, you need it to look nice. So I would take your gardening, I would take your cleaning, I would take your utilities, your property tax, your mortgage, your telephone, your landline that no one has anymore.
Nobody has a landline anymore. Your internet expense? Yeah, okay.
I mean, you're using it in business.
In business.
What I would often take more than your pro rata share for internet, because you're using the internet probably 90% of the time while you're working at home and everyone else is off at school and work.
Right.
They just used it at night. You use it all day. And so maybe we take a higher percentage than just your pro rata percentage. But that's fiddling around the margins. The big stuff is the insurance. You would never be able to deduct it. Your cleaning, you'd never be able to deduct it. Now you're deducting a percentage.
Wow. All I'm just like envisioning right now is just like dollar sign, just like an itemized list of dollars that you could save, essentially.
The more we can treat it as a business expense,
right
the better.
Yeah, yeah. I mean, and which is also why, like, you were saying, the other thing is kind of like fiddling around the margins, taking those big things into consideration, and also knowing what you can and should deduct versus what is just going to get you in trouble. Like there's a fine line, and you have to know which side of that line you should stay on, because the IRS doesn't mess around.
Every accountant knows the same phrase: be a pig, don't be a hog. Hogs get slaughtered, pigs get fat.
I like that. I think we should definitely remind our viewers, especially the ones that are in this the hoggish, which hopefully you're not being a hog, but like Dan said, be a pig, don't be a hog. You don't want to get slaughtered, especially when it comes to the IRS. You don't want to have to deal with that. The audits, there's costs associated with audits. There's time. I'm sure there's the stress associated with audits too. Like nobody's thrilled to be getting audited.
It's not scientific, but I tell my clients that have sole proprietorships and report on a Schedule C, it's a matter of when, not if, that you'll be audited.
Okay.
So just maintain your books and run your business accordingly.
That's excellent advice.
And when they audit you for 1 year, they open up the prior 2 years. Whatever is open for the statute of limitations, they're going to look at every year.
So there's a statute of limitations when it comes to an audit?
For any tax return, it's generally 3 years from the due date of the filing.
Oh, okay.
4 years for California.
Okay.
So,
California. Yeah.
In your home office, you want to store away your tax records for several years.
Okay, that's definitely good to know. Is there anything that we haven't talked about, either pre-buying, during home ownership, or upon the exit or the sale, that we haven't talked about that you think is important, or do you think we've pretty much covered everything at this point? Well, I mean, I know we haven't covered everything. You and I could be talking for hours,
right,
going really deep into the details and the nitty-gritty. But for the purposes of this video, is there anything we haven't covered that you'd like to leave our viewers with?
So I'd say there's two things that are miscellaneous.
Okay.
Often, some of my clients are buying a home, or they're getting a new home, and they say, quick, I need a trust. I haven't done it in the past, but I'm buying the house. I need to have the trust to buy it. And my answer is, slow down. You have the biggest purchase of your life coming up. Do the trust after you close. There's no harm. It's just the only incremental cost is the cost of a deed. And it's minor compared to what you're doing right now.
Mm-hmm.
Deal with the disclosures, deal with your loan, make sure you get the house of your dreams, deal with the trust in a month. So that's number one. And the point of a trust is to hold title to your house so that you can avoid probate and make sure it goes to where you want it to go if and when you pass.
You pass, right.
The second thing, for someone that has their own business, let's say an S corporation or a C corporation, you can actually pay yourself rent for 14 days tax-free, it has to be legitimate. So let's say you're one of many owners of a company and you want to have the company party at your house. They can pay you rent for the use of your house. Again, it has to be fair market value. And that's tax-free to you. The company gets a deduction.
For 14 days, you said?
14 days out of the year.
Out of the year, okay.
Now, again, don't be a hog. This is where people go crazy and they say, oh, I'm going to get thousands of dollars a day for nonsense, and they get in trouble. Make it real, and document it and prove that it's fair market value before you do it, and you'll be fine. But this is also opens up a possibility for non-self-employed people. You can have a photo shoot or a commercial shoot at your house tax-free, as long as you're under 14 days.
Oh, that's great to know. Oh, I'm so glad you brought up both of those points. I feel like, especially for the trust topic that you brought up, that's really important, and I think a great topic to delve into in another video. But I'm glad you brought that up, because it is something that I do advise my clients, if not before, at least shortly after they close escrow. I'm like, hey, look, you just purchased the biggest asset that you've ever owned to date. It's really important that you have a vehicle to protect it. And like you said, it's not if you pass away, it's when. It's just a fact of life. You want to make sure that it's going to the people that you want it to go to, and that you avoid probate, which is a long and drawn out court process, which is completely avoidable if you just take the steps to establish a trust.
And if you don't have a trust, it goes to who the state of California says it should go to, as opposed to who you want it to go to.
Yeah, and that's something that, like you said, it's completely avoidable. May as well plan for it and just take the necessary actions to make sure that you and your family have the peace of mind, which is ultimately what it's coming down to. You've just been a gem. I mean, you're just one of my favorite people. You're one of the smartest guys I know, and you really have a passion for the work that you do and for the people that you help, and you truly have been a wonderful colleague and an asset to me and my clients. I can't tell you how much I appreciate you for taking the time out of your day to come be here with me. Thank you so much.
Thank you.
And to you, the viewers, thank you so much for tuning in. I found this particular topic to be super special because I'm also self-employed. I have an S Corp. So this was really applicable, and not just to me, but to a lot of my clients who have their own businesses. I hope you found a ton of value in this, and there is a whole lot more that we could get into. But if you have any questions about this or taxation, feel free to reach out to me. I'm for sure not a CPA, but I know who I can get you in touch with. And until next time, if you're looking to buy, sell, or invest in real estate, please consider me a resource. I'm here for you. I'm grateful for you, and I will see you in the next video. Take care.